So building a position. So, is it different to dollar cost averaging? In my mind, yes, it is. And the reason, that I do this is because most trades are going to go against me before they're going to turn in my favor. If they're going to turn in my favor, of course, they don't all do that. So, the idea is to try and gain the best average possible ready for that. So what I tend to do is sort of break my orders down into three portions. So let's just say it's a 10 lot. So 343 as an example. So the middle price is going to be my average. So I'm just scaling into that position. Sometimes I may not break it into three. Sometimes if I'm actively watching the market at that particular time, then I'll just keep entering small orders in there to build up to the desired size that I want to have. Now, where I think it's different to just dollar cost averaging is the fact that I've already identified where my support line is or where my resistance line is. I've calculated how I'm going to enter into my trade. I've planned it. And then not only have I planned it, I've also calculated where I'm going to place my stop loss and how much that's potentially going to cost me if I'm wrong. And then I look on the other side of that for my risk reward. If I'm right, if the market turns, always ifs, then, where can the market get to? And, for me, when I look at risk reward, I want a minimum of 2-1. It's different for everybody. The only reason I select a minimum of 2-1 is because even if I'm only right half the time, I'm still going to end up with something in my account. And again, that impacts your winners to losers. So I like to break my orders down, and that is to build my position initially. And I'm just averaging in. But I know where I expect the market to stop. Of course, we don't get every trade right. So some of those I will get stopped out on, but I accept that. And it's not that I don't mind taking losses. I prefer not to, obviously. But at the same time, I'm not sort of, I don't get hung up on it because I've been trading so long, I expect losses. To a degree, it's just like a business cost, isn't it? And that we have to be prepared for them. I always think when I exit a position, if I get stopped out, it's reducing my risk. It's taken away that risk. It can't destroy my capital anymore. So that's the way I sort of look at risk and this particular area. So I scale into these positions and I build these positions over time. I'm a big believer in letting the market come to you rather than you chasing the market. And what I mean by that is, I set my prices of where I want to trade, and then it's up to the market to come and meet them. I'm not going to go chasing the market because, for me, it's about taking on high probability trades. I want to reduce my risk as much as possible. If you go all in on a position, then, once you've got that on and you see the market going against you, quite often you think, if I hadn't have got in so early, I could have got some better prices. So by building a position, by going in piecemeal, it gives you that opportunity to actually try and get a really good average.